Hello, folks. Welcome back to part two of our discussion of corporations. And we're going to get into the idea of the transactions with shareholders. So when a corporation pays money to the shareholders, the question really is, what is the treatment of that money? How is it taxable? Is it to the shareholders? It is not deductible to the corporation for the most part. So to know if it is taxable, we first have to understand what the corporation has, what's called earnings and profits. It's very similar to retained earnings. Basically, all the income that has been made by the corporation on a taxes basis that they have not given to shareholders in any way. They've retained it or kept it. That's what earnings from profits is. It's just calculated using tax law instead of accounting rules that you may have learned in another class. If we distribute cash or property out of that earnings and profits, if the amount you're giving is less than what the corporation has as earnings and profits, then it is dividend. That makes it taxable to the shareholders. Taxable dividends could be qualified dividends and therefore have a special tax rate, but it would still be included in income for the shareholders and is not deductible, like we said, to the corporation that paid it. If you distribute more than is in earnings and profits, all right, so if the earnings and profits are $50,000 and the distribution is $60,000, then the first $50,000 would be a dividend. Any additional $10,000 would be a return of their basis in the stock. So the corporation is giving back the money that the shareholder originally put in for their stock. All right, and that is not taxable to that stockholder. So the stockholder receives a dividend, that's taxable. The additional amount, it pays back the basis in the stock, that's non-taxable. If the distribution is more than both of those, more than the earnings and profits, more than the basis in the stock, then any additional amount is capital gain, because now we're getting not just back what we put in, but we're getting additional monies. That's the definition of capital gain. If the property has a fair market value, okay? So for instance, instead of the corporation giving to the shareholder cash, they distribute a piece of property. That piece of property to the corporation has a basis of $50,000, but its fair value is $100,000. The corporation recognizes a gain, increases its earnings, increases its taxable income, increases its earnings and profits by the amount of that gain, even though it hasn't technically sold that asset, just because it's planning to distribute it to the shareholder. That gain goes to the corporation. Then the distribution is the fair value of the property, the $100,000, not the basis. All right, and so that amount of that distribution, and then we would look at that $100,000 and determine whether it was more or less than the earnings and profits, more or less than the return of the original amount they put in, and so forth, just like it was if it was cash. If we do a full liquidation, meaning we just buy out, okay, the whole corporation disappears, okay, and distributes what's left over, they record all assets and liabilities of fair market value, record gain or loss. Typically that's going to mean that it's going to be mostly loss, okay, and the shareholder reports capital gain or loss equal to the fair value, market value of the distribution compared to their stock basis. So remember, we talked about the basis I would have in my stock when I originally put my money in or my other assets in. What was my basis in my stock? At the point that I get a distribution, that it's over, the corporation is done, we sell all the assets and give me back whatever is left, if I get more than my basis, then I get a gain. If I get up to my basis, it's just a return of capital, and it could be where I have a loss, where I get less than my basis and I have a loss on that stock. So, corporation has earnings and profits of $10,000, makes a cash distribution to its sole shareholder in the amount of $11,000. The amount of taxable dividend to the shareholder is $10,000. The other $1,000 would be a return of their original basis, whatever that was. Would be, then, if their original basis was $20,000, that would now go down to $19,000 for the future. So there's some unique parts of the Form 1120. There's Schedule L, M1, and M2. The Schedule L, this applies to bigger corporations. Smaller corporations, you don't have to do this, but it's always a good idea to be able to complete these to make sure that you've included everything you should on the tax return. Schedule L is simply a beginning-ending balance sheet, just to show the assets, liabilities, and equity of the corporation at the beginning of the year and the end of the year. The M1 schedule is far more, you might say, confusing, but also has more of the information that we're looking at. It's a reconciliation from the book income to taxable income. This is how much the book income is on the financial statements, the income statement that we use at the bank, that sort of thing. And this is how much the taxable income is on this tax return. So that's all the differences are listed on the M1 so that you can literally see what the differences are. Some are added, some are subtracted. Okay, some are positive adjustments. They're added back, all right, to book income to get taxable income. All right, you'll see some listed there. So if you're over the current year charitable contribution, that only applies to taxes. The meal expense, 50% reduction, that sort of thing. And then those are the differences. Another set of differences are negative adjustments, subtracted from book income to get taxable income. So we take that out of our book income to get to taxable income. So the M1 has both the positive and the negative. They have actually two columns, okay? And the M3 is a much more comprehensive for large corporations we're not going to worry about, all right? So some other things that can make sound complicated but actually are designed to make our life a little easier. This was more important when we had multiple tax rates for corporations. Today, the same tax rate applies to all corporations and no matter what your income is. So there's not much point there was some tax savings if you could split apart into multiple corporations. Now there's not anything that helps you with that. So there's no reason not to file together when you have a parent subsidiary group, meaning basically treating multiple companies that are legally separate as one company because a common shareholder owns all of them, okay? 80% or more. They can just file one return and put everybody together, making everybody's life a little easier in that there's only one tax return to process rather than 3 or 4 or something like that. And then if the brother-sister group, where group owns at least 80% of the voting shares, okay? So the same person owns, so George and his brothers owned 4 different corporations. They could file together. If they were all the same, they own the same percentage of each of the corporations, okay? Not that they all have the same single parent, okay, but that they all are brothers and sisters because they are all owned by the same few people. That would be, you could also put together in one return. All right, the business interest expense limitation should only come into play in a very few cases. For 2020, they increased that to 50%. It was 30% previous, so for 1 year only. This doesn't apply to any company with $25 million of gross receipts or less. So this is to go after big corporations that borrow lots and lots of money and have lots of interest expense, and therefore wipe out a whole bunch of their taxable income and therefore pay less tax. That's not going to work if you're a big corporation. You're going to have a limit on how much interest you can pay in terms of, and as far as deduct, you carry it forward. And you can pay all you want, but you can't deduct it until you go maybe to the next year. All right, probably more common than the C corporations is an S corporation. They follow the same formation rules that we talked about, the same 80% rule that we talked about in terms of making it and having a no gain on contributing money to the corporation. So an S corporation is a corporation that has elected, they have to send in a form. You do not become an S corporation automatically. You have to tell the IRS you want to be an S corporation. Filing a 2553, okay, it has to be signed by every corporate stockholder, and then once that's approved, you file the 1120S. That's due on the 15th day of the third month. 1120s are 15th day of the fourth month. 1120S third month. 6-month extension permitted. You can't be an S corporation unless you can show that you fit all 4 of these these criteria. Domestic, can't be foreign. Okay, 100 or fewer shareholders, but family members count as one. So 4 people of the same family will count as one shareholder. So it's still, there's a lot of, you can have a lot of folks involved. One class of stock, you can't have different voting rights for different stockholders. And shareholders have to be U.S. citizens or resident aliens. They cannot be non-resident aliens. Can't be someone in another country. Can't be other corporations. Okay, they have to be individuals. Okay, it can't be other entities. They have to be individuals that own the stock. They report taxable income in separately stated items. That sounds very much like partnerships, and that's true. They are much more like partnerships than they are like C corporations. They have separately stated items. They have their regular ordinary income, typical things, and then they separately state income that has special tax treatment, like capital gains, interest, that sort of thing. Charitable contributions are broken out for an S corporation. The S corporation does not pay taxes. They pass through their income. So they show all the items of income on the Schedule K, and then it gets separated by the percentage shares that each shareholder owns onto their K1. So if the Schedule K shows that the corporation made $50,000 and the shareholder shows that he owns 50%, then that 25,000 or 50% of that their income would go on the K1 for that shareholder. Basis is the same idea. It basically limits how much can be deducted if the S corporation has a loss. So if you are a shareholder in an S corporation and the S corporation has a bad year and loses money, the typical idea is that that loss is separated between the shareholders based on their percentage ownership. The question is, as a stockholder, can I use that loss to offset income from other sources? And the issue is, goes back to the idea, is it at risk? Do I have money at risk in this S corporation? The amount at risk is my basis. The basis is typically the amount that I originally invested in the S corporation. That can go up as the net income, when net income goes up, and by any separately stated items. They increase my basis. If I put more money in, my basis increases. All right? The big difference between an S corporation and a partnership is that S corporation, the stockholder does not increase their basis by the corporation borrowing money unless it's from the stockholder themselves. So in a partnership, if the partnership borrows money from anyone, all right, partner, anybody else, the partners all have an increase in basis with that loan because the partners are liable for that loan. So they could lose. They have an amount at risk. For an S corporation, stockholders are protected from that liability. They do not have that liability. And so if the corporation borrows money from the bank, that does not increase my stockholder basis. However, if they borrow money from me, that increases my basis. Because I could lose that money. That is at risk. The basis is decreased anytime the corporation loses money. Any separately stated negative items, anything that a non-deductible expense or anything like that, separately stated, all right? And if I get distributions from the corporation. And again, if this was an S corporation and they were going to distribute an asset that had fair value more than the basis, the S corporation would recognize a gain on the asset and then they would distribute it to the shareholder at the fair value. So just like a C corporation, they would recognize gain. The difference would be that gain would increase the income to the S corporation and be passed through to the shareholders. They would then show that gain on their K1. Your basis can never go below 0. You can't have a 0. So if there is a loss is too high, more than what you have at risk, you have to carry it forward until you increase your basis. All right? So that's what we mean by carry it forward. So the general rule, and this is what we sometimes lose sight of, S corporation distributions are not taxable. So when money is paid, unlike a C corporation where we have the dividends that could be taxable, an S corporation pays money to the stockholder that is not taxable. Instead, the stockholder is going to report the income when the S corporation makes it. That's going to be passed through to their K1 for the stockholder and put on the Schedule E, page 2, for the stockholder and be income, even if they didn't get it. So income by the corporation is taxable to the shareholder, but distributions are not, just like a partnership. C corporation, income to the corporation is not taxable to the shareholder, but distributions could be. So it's just the opposite.